Welcome to Scalpers University, Module 1 Psychology, Lesson 3, Game Theory. Game theory to me is the most interesting and relevant part of trading. Everything essentially is a game, and within a game there's winners, losers, not always in equal measure, but there's always a bigger battle going on. You take things from a higher perspective, you'll see that it's not about money or candlesticks or anything like that. It's really just about who can get the edge on their competitor or on the market by reacting more favorably to a set of conditions. So first, I want to talk about what game theory is, just from a very high level. So game theory is a framework for explaining the interactions among competing players within any situation, whether that be a game or a more serious scenario. Game theory is essentially the science of strategy and decision making, and it all revolves around incentives. Okay, so anywhere that exists incentives, you should apply game theory to your thinking. And as you can imagine, pretty much everything in life has incentives. Now, you mightn't be aware of some of them because they're not that important, but what's the incentive for you brushing your teeth in the morning and at night? Probably some programming from when you were younger where you were told, if you don't brush your teeth, they're going to rot, fall out, or you're going to get fillings, or they're going to be whatever. Or you're going to have to keep going to the dentist, and you didn't like going to the dentist, and so you brush your teeth. You never really thought of that, but that was an incentive. The incentive was, I don't want my teeth to fall out, and so I have to brush my teeth. And in essence, that was a game, a decision within a game, where it was you versus your parent, let's say, who was impressing upon you the need to brush your teeth. You were completely unaware of what was even going on. So you were, a sleeping participant in that particular game. And probably up until now in the markets, you've also been a sleeping participant because you haven't had a firm grasp of what goes on beyond the candles. What is the meta that I've spoken about in previous lessons? And within that meta, what is the sub-meta, if you could say, for lack of a better term? Where on a day-by-day basis, and as scalpers on a minute-by-minute basis, there are also games going on too. So things like news events. As I record in January 2022, a hot topic over the last few months has been the Federal Reserve raising interest rates, stopping the money printer, all that kind of stuff. And we have Fed meetings, we have CPI, so inflation numbers getting released, all of that good stuff. So when you look at it from that lens, that's your meta, that's your kind of your sub-meta game within a game, where on a Wednesday at 4:30 or whatever the timing is, the news gets released and a little game plays out within the charts, which actually has nothing to do with the direction of the market. It doesn't have a higher time frame directional bias. It's all about people reacting to news, and essentially whoever can react best. It's a bit like poker in that sense. The news comes out, so the news is the hands being dealt, and then how each participant reacts to that, how they play their cards, will determine whether they win, maybe they fold, maybe they go all in, and maybe they win that, maybe they go bust. So if you're not aware of what game theory is, beyond what I've just said, you may have heard of the prisoner's dilemma, which is a famous story or description, I suppose. It's not necessarily a story because it's not based in real life, although there's something that this could absolutely happen in real life. But the scenario plays out well what game theory is and how it works in a very easy to understand and practical sense. So I'll run through that quickly, then we'll apply it to trading, to the markets. So in the prisoner's dilemma, you've got two suspects. So they've been arrested for a crime and they're now in separate rooms in a police station with no means of communicating to each other. Okay, and the prosecuting officer has separately told them the same outcomes for what can happen next. So there's four outcomes. One, if you confess and agree to testify, so you essentially snitch on the other suspect, and they don't confess, charges against you will be dropped. Okay, so you get no time in jail if you confess and he does not confess. So basically, if you cooperate and he does not cooperate, then you go free. If you do not confess, but he does, you'll be convicted, and prosecution will seek a maximum sentence of 3 years. So you'll get 3 years in jail if you don't confess, so if you don't cooperate, and he does. Third option is if you both confess, you're both going to get 2 years in prison. Final option is number 4. If neither of you confess, you'll both be charged with a lesser sentence and be sentenced to 1 year in prison. The science of game theory, as you can see from the matrix structure that's on the screen, it's all dealing with what should the suspects do in this scenario, all right? And that's directly applicable to markets. So in any scenario you're in, you want to look for what the dominant strategy is. Dominant strategy for a player is the one which produces the best payoff, regardless of whatever may happen outside of you. So it's all about dealing with what you can control and not dealing with anything that you cannot control. It's not as simple as just saying, well, I'm going to cooperate or I'm going to defect or whatever. You have to think about the decision you can make that's going to give you the best outcome regardless of what happens with him. If you both stay quiet, you both end up with 1 year in prison. If you confess and he doesn't, you go free, he gets 3 years. If you don't confess and he does confess, then you end up 3 years. And if you both confess, you both get 2 years in prison. So, let's imagine it's you're A, suspect A. If you confess, you're either going to get 0 or you're going to get 2 years in prison. If you confess, there's basically a chance you're either going to get 2 years in prison or you're going to go free. Pretty much an equal chance, okay? If you decide not to confess, you'll either get 1 year in prison or 3 years in prison, all right? So you're starting to see now that when you lay it out like that, it's quite a simple decision, okay? If you confess, your choice is 0 or 2. If you don't confess, your choice is either 1 or 3. So very clearly the best strategy is to confess, regardless of what the other suspect does, okay? Because in that type of scenario, if you have a choice that can minimize the worst case scenario, you choose it, all right? So if there's one of them which has 3 years as one of the possible outcomes, and the other decision has less than 3 years as the worst possible outcome, then you must choose that. So that's kind of a broader overview of what game theory is, and you can apply this in trading. You can apply it in, especially in things like Ponzi's. So on the same note, when we're talking about incentives, if anything has incentives involved in it, you should apply game theory thinking to it, and you should attempt to game it. Now, it's not as simple as just saying, here's the problem, here's my first idea for a solution, here's the positives and negatives of that solution, and that's it. Very binary. Bitcoin goes down, RSI on the daily goes to 30, positives are it's oversold, I'm going to buy, and I'm going to use a stop below the low, the most recent low. It might work sometimes, but really it's very, very shallow thinking, and it's essentially first order thinking, all right? Where you're only thinking of yourself within one scenario. As you can see on the screen there, what you want to get to is second order thinking, which is where you think of the first solution or the first decision and all the positives and negatives from that, but also the future consequences of making that decision. And this is then where you get to the point that you're able to actually make a different or a better first decision based upon the fact that you've thought beyond that first decision and factor in all the other variables, such as other people and other data and other market forces. So for second order thinking, you have your first decision. What are the immediate positives and negatives to that? But then you go one step further. You identify the consequences of that decision, second level, third level, and beyond. And then you reflect on that. Then, after you've done that, so after you've questioned your second and third and fourth level outcomes, you want to then make a decision, and that decision will be where the second and third order consequences are positive. Okay, that's the focus. All right, so your first solution, your first decision may not be positive. The first thing that happens may be a negative, but it leads to positives down the line. Collect your feedback and then loop it back around to produce better results the next time. You should be aware of that fourth step I said, which is the decision, where you choose a decision where the second and third order consequences are positive, even if it's at the sacrifice of your first order consequence, right? That's in chess, sacrificing. If you sacrifice a piece, or if you make a play that in the short term that is detrimental to you, but 2, 3, 4 steps away, moves away, it's a positive, it's a strategic move. That's why, you hear about a chess player and they say, he's always 4 or 5 steps ahead. That's second order thinking, right? Thinking beyond just the first. And rule 13, game theory leads to greed, which leads to fear, and all of that equals reflexivity. And you can see all this encapsulated perfectly in a chart. So just by the very nature of the market, especially the crypto markets, the game theory dictates that it inevitably leads to manifestation of greed. You bought SHIB before the pump, it's now pumping. You have to ask yourself, if I don't sell and he doesn't sell, then we both get richer. But if I do sell and he doesn't sell, then he gets richer and I get poorer. But you have to remember that people are irrational when it comes to money. So in the heat of a bull market, they don't think, what if he sells? All right? You have to remember the person you're battling against, the average person, is greedy, and you need to feed off that greed, because only smart money thinks like that. Only smart money says, what if he sells here? And what if I sell here? What if I buy here, but he sells? What if I buy, but he sells, but person C comes in and they buy? That's the smart money is thinking that way. The dumb money is just thinking, well, I'm just going to keep holding because price go up. And the same thing on the way down. The bad traders, they think price keeps going down, so I'm going to keep shorting it. That leads then, when a trend shifts, leads to the opposite, where it's, I must get out because he's definitely going to dump on me. And even the bad sellers, the bad traders then will start to capitulate as we go down and down and down. Some will bag hold. As you go down this chart, you basically see the trading skills get worse and worse and worse, because the giga-chads sell it at the top, and then all the way down it just gets worse and worse and worse, and the IQ of the average person selling gets worse and worse and worse as you go down. So what it leads to is reflexivity. This is why you see so many charts, especially in crypto, that have this exact pattern where it's fucking parabolic up and then just bleeds out to infinity. Because on the way up, people don't want to sell because it's going up. When it's going down, they do not want to be in the way of it, so they get out. That's why you see such a big crash initially. And then the reason you see a bleed after is because nobody wants to buy it. The smart money or the strong hands or the whales or whoever, they've managed to hoover up all those capitulated coins, and then they can run it back up again. So when you see charts like that, what you're actually seeing is pure reflexivity, and that's an expression of the decisions made by self-interested parties from a game theory perspective. All right, everything within that chart, from the way up where nobody wanted to sell because they're greedy, to the way down where everybody's selling because they're fearful, that's all people thinking from their own self-interest. So if you can just go one step beyond that and don't just think in your own self-interest, think about how other people are acting in their self-interest and counter trade that, that is when you can transcend to being a trader who trades off people, trades people, not price. And so it takes us to number 14, which is you only ever have 3 choices. Okay, in the game of trading, you can either buy, sell, or do nothing. This is also why it's so profitable to catch trends in crypto. You know, the people who say that the market immediately prices in and discounts everything to every new piece of news or new piece of data, it's complete bullshit. Trends exist because people are not good at pricing markets. Okay, trends exist because when you feel like it might already be too late, as you see there on the chart, you are usually wrong. Whenever you have that feeling saying, oh, it's too late, look how much it's up already, it's generally actually a good time to get in. Because from a game theory perspective, if you're thinking that, and I like to think that you're all going to be above average traders, then the average trader and the really dumb money, they're also thinking that. And what does that mean? That means it's a good time to buy because it's a market. The people that we want to sell to are always going to buy green candles. So even though it's up, we can start getting it to go up more. You can see what happens there. It happens time and time again in crypto. You get that final parabolic blow off leg. You know this feeling. Everyone here watching this will know this, where you've saw a coin, you've felt it's already too late, it's gone up too much. You go to sleep, you wake up, and it's gone up 50% overnight. And then out of anger that you didn't pull the trigger the previous night, you then buy it and it proceeds to drop 40%. That's exactly that playing out. You have to remember that you are not separate from the market. You are the market. You contribute to the market and you're just a human like everyone else. You have no way of combating the same cognitive biases and flaws that any of us do. Some people are better at trading that way, but every single person feels them. I feel those biases and I feel every one of those emotions just as much as you guys do. The only thing is I've trained myself to trade counter to that when it suits or when it seems like it's plus EV to do so, and that's all you need to do. You don't need to change yourself and become a monk or become a robot. That's stupid. You just need to become more aware of your emotions and track what typically happens when you act in a certain way. All right? You feel like it might be too late, then it goes higher, it goes to game theory, like I said, then you capitulate and go long, which marks the top, and essentially you've been gamed at that point. You have lost that game. Very binary, and think of it that way. Don't think about the money, forget the money. It could be $10 or $10,000 you lost in that trade. You lost the game, all right? There's always another round. You can respawn, go again. But in this scenario, and at every point, you have 3 choices, but only 2 of them are active, right? You are not in the game if you choose C. That doesn't mean that choosing C is bad. You don't always have to be in the game. In fact, you don't want to be always in the game because it's very destructive mentally to constantly be worrying and thinking about the markets. So doing nothing is often a very good thing. But when you do nothing, still observe, watch what happens. When you can zoom out and look at it from this perspective, it's pretty clear that it was going to go higher again because these moves, you see it over and over and over again. In fact, they typically do 3 legs. This one only did 2, but just because the second one ended up being all in one go. But you can see, quite clearly that you can jump into trends all the time in crypto. Now, rule number 15, losers anticipate, professionals react. So caveat on this one, this is as a trader, not a long-term investor. So as a long-term investor, yes, you want to be anticipating because that's kind of the point. You need to look ahead, form thesis based upon what may happen in the future with all the data you have in front of you. The market sentiment, depending on when you're watching this, you'll either know this now or you'll be aware of it from the past. You'll remember this feeling. So you can see on the chart where it said November CPI. On the day of the all-time high, the consumer price index, which is a measure of inflation, came out and the inflation was at unprecedented levels. Inflation is bad for risk assets and Bitcoin is a risk asset. So inflation being high eventually leads to interest rates rising, all things being equal, which means debt becomes less cheap, which means less money gets pumped into the system, which means assets like Bitcoin don't go up as much. So all this was known and we still hit an all-time high. Now then, smart money exited. They had exited some before that. They definitely exited at the top and they exited after the top and they got out pretty much all above 60 and they were out because they prepared for all this. They knew that the run up in November was essentially just exit liquidity, because 2022, the probabilities are 2022 is not going to be great. So when we get a pump like this, we're going to get out. Then we drop down, and now we see things like the Fed accelerated tapering in the middle of December. So they announced, yet not only are we tapering, which is reducing the asset purchase, we're actually going to taper faster. So we're going to reduce purchases faster. We're going to take money out of the markets faster, essentially. And now dumb money catches on and they flip bearish. Whales are accumulating at these levels because they sold at 60. They're going to buy here because they'll be able to then just sell it back. So if you just pump a nice little green candle into the market, it gives everybody amnesia. The dumb retail will forget all about the Fed. They won't even know what the Fed is. If we have 3 green candles in a row, 3 days up, and we're at 54k, retail will be tripping over themselves to buy Bitcoin again. And whales know this, and that's why it's going to pump sooner rather than later, because it makes no sense not to. The whole point of that was, you want to be a reactionary trader to that, not an anticipatory trader, okay? The smart money were anticipatory back when it mattered, again from a long-term perspective. The dumb money are anticipating lower, even though the market's way down. Inflation's rampant, tapering is going to accelerate, blah, 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 blah. I want to be a buyer, not a seller. Do you see how that makes sense? If someone's parroting back to you already known knowledge or known news, not unknowns, and they're saying that as a reason why it goes lower, you want to be buying. And same thing, if it's for why it goes higher, you want to be selling. When we were at the top, and this one's probably a good example, when we were at the top and we'd already had a couple of Bitcoin ETF approvals, suddenly the kind of, we're at in the mid 60s, and the narrative was like, well, this other ETF approval is due to come through on Friday. And then, suddenly you're at the point where you're like, well, is the only thing that's going to push us up being more ETFs getting approved? And obviously at that point, smart money had decided, with all the other things, with the bearish 2022, etc., that another Bitcoin ETF wasn't going to pump price. So just as tapering, inflation, selling, that's not going to push us lower now, most likely. You need to be a buyer in that situation when everybody else is selling. Rule number 16, leading on from that one, green candles cause amnesia. So that's just a nice way of saying, encapsulating the rule. But what that means is you want to counter trade the bad traders in the market and the traders who trade based off emotion. So the full quote that I have for that, I've put it on my Twitter before, where it's red candles cause PTSD, green candles cause amnesia. So what that means is these big red spikes down, these big, I know they're not red on my chart, but the big candles, the big down candles, they cause fear and anxiety and anger because you got liquidated and you got stopped out and you panic sold. So they create that real bad feeling. And that's important because that is the feeling when it's down here, like, no, it's going lower, oh God, you don't even want to look at the chart, it's so bad. And that's important because that lack of emotional control is what stops somebody from buying. And at the point where they should be buying, they're still bearish. And then it bounces, and suddenly they start to feel a little bit better again, or they feel a little bit more confidence. And this is how people get destroyed in ranges, choppy ranges. The emotion of the down candle gives them that horrible feeling. Then they move up, and suddenly you get 3 or 4 green candles in a row. What do you get? Case of amnesia. As it goes up and up and up, you're like, yeah, everything's good with the world. Oh, look, V reversal. Oh, pump it. And they've all these reasons and feelings and blah, blah, blah. And that's exactly what it is. It's green candles make you complacent. Red candles make you indecisive. And then by the time it really dips, they get stopped out or liquidated. That's exactly when they call the bull market to be over. And of course it bounces. And they go, oh shit, maybe I was wrong. We are going to break out. They buy it. And then we drop off. So that whole thing is an example. I know I've certainly been there in the past. We've all been there. It's how you learn. The thing is, get it out of your system as quickly as possible. And forget about what the chart looks like. And stick to your proven principles, your proven strategies. And just remember that whenever things are going down, it's typically a good time to buy. When things are going up, it's typically a good time to sell. Now that's not a hard and fast rule, but if you can think that way, it's going to stop you having the green candle amnesia and the red candle PTSD. And that's what I really want to impress upon you to avoid. Known unknown equals buy, unknown unknown equals sell. So this is to do with how you process information and react to it with events, news, etc. So known unknowns are things that we are aware of but don't understand, and unknown unknowns are things we are neither aware of nor understand. All right, might seem a bit confusing at first, but those are the only two that matter for my trading. The other two you can see that are crossed out. They're important from a decision making standpoint, but not from a trading standpoint, because this particular rule where you can just buy a known unknown and sell an unknown unknown is fairly reliable to the point where you can be profitable. And dig a little deeper. So what's a known unknown? A good example would be the Federal Reserve meet, right? We know we're aware of of it, so we know it, but we don't know what's going to come out of it. We don't understand what the news is going to be or what they're going to say. You typically want to buy those because everybody is anticipating, so the bad anticipatory traders, not the long-term visionaries, the short-term, who 2 days before or the day before or the day of the Fed meeting, they start to sell because they try and front-run this imaginary news. Then the news comes out, it seems bearish, it drops the market a little bit, the dip gets bought up, and we pump again. We've seen that so many times that when it's a known unknown, the general rule is you should buy. Now, don't get that mistaken with an unknown unknown. An unknown unknown, you should sell. That's things that we are neither aware of nor understand. That's complete chaos. That's a black swan event. That's the COVID crash. All right, for anyone who was trading around then, the COVID crash wasn't as simple as people make it out to be now, where they say, oh, look at that, the greatest dip buying opportunity ever. No chance. That is not what people thought. People thought the markets were literally going to zero. But also, they were crashing for a number of days. And so when you hear an unknown unknown, you have this thing called COVID and it's affecting the markets, the smart trader would get out on day 1 or 2. Not because they know what way the market's going to go, but because they know that this is literally an unprecedented once-in-a-lifetime event. It is a definition of a black swan event, and in that case, you just get out and wait. All right? So China banning crypto is another good example of a known unknown. We're aware of it. We know China do this, but we don't understand, we don't know when it's going to be released, or we don't understand the intricacies of this particular time they release it. But we know that from the past, it's always been a good decision. It's always been plus EV to buy when China bans crypto, because we always recover. All right, so there's the two differences in them. If you see those scenarios coming up, you'll get known unknowns a lot more, so you get a lot more buy the dip opportunities, and that's basically whenever we get Federal Reserve releases or meetings or notes or news, especially when the market is anticipating it to be bearish. It's always a good time then to buy, and you're not going to be right 100% of the time, but a fairly good, fairly high strike rate. You're going to catch some good longs, you're going to exit them on the scalp, and you're going to make some money. So that's game theory covered. We're going to now go into module 1, lesson 4, which is all about thinking like a whale. So jump into the next video for that.